Let's dive right into Stamford Tyres' latest financial results. Now, at first glance, the numbers look a little worrying, but as we're about to see, there is so much more going on here than meets the eye. Let's get into it. Okay, so let's get right to it. The headline number that jumps out from these results is impossible to ignore, and, it's not exactly good news. The company's profitability, well, it's taken a pretty big hit in the first half of the year. And here's the number that tells that story. A nearly 60% drop in net profit. To put that into perspective, for every dollar of profit the company made during this same period last year, they're now making just 42 cents. That is a huge drop, and we absolutely need to understand, where did all that profit go? So this table really breaks it down for us. If you look at that top line, revenue, it was basically flat. So they're selling just as much stuff as they were before. The problem isn't that people stopped buying tires. But then look at the next line down, gross profit. That's the money left over after you pay for the tires themselves. And that number is down almost 5%. This is where the problem really starts. And that pressure, it just snowballs all the way down to that final net profit. So what's causing this squeeze? To really figure this out, we need to look a little closer at that flat revenue number. You might think it means the company is just, treading water, but there are actually some really big shifts happening right below the surface that tell a much more interesting story. And this slide, this is what I'm talking about. It really highlights that regional story. In their main market, Southeast Asia, sales were actually up by more than $1 million. That's a great sign of strength where it really counts. But, and this is a big but, that gain was almost completely wiped out by a pretty big drop in sales over in Africa. So this isn't a story of just overall weakness, it's more like a rebalancing of where their sales are coming from. Okay, so that flat revenue is one piece of the puzzle, but it's not the whole picture. The real pressure, the thing that really crunched profits, came from the other side of the equation, costs. This is where things get really interesting and where we find the main reason for that big profit drop. And here it is. This is the core of the problem. Their gross profit margin fell from 25.3% down to 24.1%. In simple terms, that means it cost them more to get their tires ready to sell, but they weren't able to pass all of that extra cost onto us, the customers. Now, a drop of just over 1% might not sound like a lot, but when your revenue is over $90 million, well, that has a massive impact on your bottom line. But hey, it is not all bad news on the cost side. While the cost of the tires themselves went up, the company did a fantastic job of controlling their other expenses. Things like rent, salaries, marketing. They actually cut these operating costs by 3.4%, which really helped to soften the blow to their profit margins. Without that kind of discipline, the drop in net profit would have been even worse. So we figured out that profits are down, caught in a squeeze between flat sales and rising costs. But is profit the only measure of a company's health? To get the full picture, we've got to look at something that's arguably even more important, cash. And this right here is where the story takes a surprising and honestly a really positive turn. Because while those profit numbers look pretty weak, the company's cash situation is actually incredibly strong. It's a classic case of the income statement not telling you the whole story about the real health of the business. I mean, the numbers here are just wow. Take a look at the operating cash flow. They went from burning through nearly $12 million in cash last year to generating over $5 million in positive cash flow this year. That is a $17 million swing. So how'd they do it? Well, the main reason was just really smart inventory management. They sold off $7.5 million worth of tires that were just sitting in a warehouse, turning that idle stock into cold, hard cash in the bank. That's just a sign of a really well-run company. So we've got this kind of split picture, right? Profits are weak, but the cash position is strong. With that in mind, what does management see when they look down the road for the next 6 months or so? Well, management is not sugarcoating anything. They're telling us straight up that things are tough out there. They're pointing to intense competition and just a lot of global uncertainty as major headwinds they have to deal with. It sets a very cautious, very realistic tone for what's to come. So what's the game plan to navigate this tricky road? It's a pretty clear 3-step strategy. First, they're going to optimize their product mix. Basically, focus on selling their most profitable tires. Second, keep a really tight grip on those operating costs, building on the success they've already had. And third, they're going to double down on their core strength in Southeast Asia, which is where we saw that really nice underlying growth. So that's really the story of Stamford Tyres. You've got a company facing some serious profit headwinds, but underneath it all is a strong, cash-generating operation. They've got a clear plan, but they know the road ahead is bumpy. The big question is whether their internal strengths, their smarts, can overcome all these external challenges. It's a classic battle between discipline on the inside and pressures from the outside, and it's going to be fascinating to see how it all plays out.